Hi there. How's it going?
Hey, good.
Yeah, I'm here with David Jaffee from his
Stock strategy.
Best Stock Strategy. Yeah. And mine is Finance ABCs, as you all know. And David, tell us about your option strategy and how did you come up with that strategy and how well is it working for you?
So I sell option premium, and the way I came up with it was I felt like many other of the other types of investing were kind of like gambling, where you would buy a stock and then you would pretty much be a cheerleader because once you own the shares, you would just simply like passively wait and then hope that it went up, but you wouldn't know when to sell it or how long to hold on to it. And additionally, some of the other more risky trading strategies like buying options or day trading or forex, it never really seemed to me like I had a way of consistently making money. Like if I was profitable, then it could have been due to luck, but how replicable was that actual trade? And I found out that when I would either buy options or day trade or trade forex, it was very difficult for me to replicate that. And I didn't get the feeling that I actually had a legitimate trading strategy to earn consistent profits. Now, with respect to selling options, it definitely has a learning curve. And the primary learning curve is that you win about, depending upon how far out of the money strike you sell, you can win upwards of like 95% plus of your trades. However, the big kicker with that is just because you win over 95% of your trades does not necessarily mean that you're definitely going to be profitable. Even this past week, when you saw an increase in volatility by close to 100%, that could wipe out an entire year's worth of gains. So I think that learning how to be disciplined is extremely important because if you're not disciplined, then even if you win 90 to 95% of your trades, you can end up losing money in the long term.
Yeah, but if you hold the position until expiration, you're home free with it, even if the volatility increases the premium along the way. At expiration, you make the money anyway, right?
Yeah, I mean, that is true. The problem with that is a lot of people tend to trade too large. So let's say, I believe personally that your biggest enemy is not necessarily the current market price of the underlying relative to the strike price, but your biggest enemy is actually the volatility expansion. If you look at what happened this past week when the VIX increased from 15 or around 16 to all the way to 30 intraday, a lot of people, if they trade too large, they're going to end up getting a margin call and then they're going to be forced to close out that position only to then see on Thursday and Friday the market increase and then actually realize a profit on that position. So from your standpoint, yeah, I agree with you that at the end of the day, as long as on the day of expiration, you can either own the stock significantly below where it was previously, or you can additionally keep the premium. The problem is that if you sell like a long dated option and you sell too large, too many contracts, then your broker might not actually allow you to hold on to that position. I know that this past week, a few of my students who have interactive brokers just randomly decided on Wednesday to increase the margin requirements on some of the underlying stocks. As a result, you might be right, and your your strike price might be below, if you're selling puts, the current market price. But if you run into a margin call and you can't meet that call, even if you're right, it doesn't matter because you're going to be forced to take a loss on that position.
That underscores the importance of staying power, right? Because
Yeah,
the market can be irrational longer than you can stay solvent, is what I always say. But
yeah.
yeah, I know interactive. I've dealt with interactive brokers before, and I know they can do that. They can arbitrarily change the rules of the game at any time, but they are consistently the best margin terms, the broker that offers the best margin terms out there,
Yeah.
and excellent execution. So wonderful. So yeah. So what are the biggest mistakes that you see traders making these days?
I definitely think that the biggest mistake is that they get overconfident, where they'll end up winning a lot of their trades by selling option premium. And then they're not going to be satisfied with earning like 2% a month or 3% a month. And instead, because they'll sell puts on something and then the underlying stock will end up going up. and then the option will end up expiring worthless with about a $20 or $30 safety net. They're going to sell puts the next time, which are more aggressive, or they'll sell too many contracts. And then they'll run into a situation where the market corrects by 5%, or where volatility increases, 50 or 100%, and then they'll end up losing money because they will end up running out of buying power and being forced to close that position. The other mistake that I see traders make is they just lack discipline. And I mean, not a lot of like your viewers or a lot of my viewers who primarily sell option premium, but I think that a lot of people in general, they tend to lack discipline and they tend to gamble. I mean, it's human nature where you'll eat a piece of candy right now because it makes you feel good, but you don't necessarily think of the long-term consequences of the sugar spiking your blood insulin levels, or it degrading your future ability to think clearly because you have too much, it's just eroding your health. So that type of things, like just people in general have a propensity to be pretty short-sighted. And they also tend to think that they have to make trades in order to make money, when in reality, you're not necessarily rewarded by taking action. Instead, you make money by making good decisions. And good decisions is choosing a good strike price, choosing a good underlying to make a trade on, collecting enough premium, but making a haphazard trade is not necessarily a great decision.
Yeah, no, I see a lot of traders trying to time the market, and that's terrible. I've seen some of your videos where you say, well, the market has a bias to go up anyway. So if you buy at a low enough point and you have an out of the money put that you just sell premiums on, you're home free. You can collect that month for sure. And you're not actually timing the market because you're betting that the market is going to either stay the same or go up, and then you win. But you do have to have the staying power to deal with it if it goes the other way, right?
That's what I was going to say, right? Because, for example, let's say, so Tesla was up, I think last year, like over 1,000%. And then even early this year, I think on January 7th or 8th, it was up around 15, 16 or 17%. And it hit a high this year in 2021 of about 900. So let's say Tesla fell to $780, and you think, wow, just a few weeks ago, it was trading at 900. I'm going to sell a $700 put on Tesla with an expiration of 3 months from now, because I would be happy to own it at 700 when just last month it was trading at 900. Well, right now it's trading, I think, at about like 600. And just this past week, it fell to about like 560. So in that situation, you have to make sure that you have a plan just in case you're wrong. And those people who don't trade too large, they will be able to roll that position down and eventually make money. But if you're going to bet on the direction, you have to make sure that when you sell options, because of the leverage that's involved, that even if you're wrong, you need a plan where if you're wrong, you can still make money.
Yeah, I made a video in February that I actually sold Tesla at around 800 and something. And, it was luck in part, but I also felt, kind of creepy that the thing was just, the valuation was out of the world. I had seen it go up after it got included in the S&P 500 in December, and it just shot up like crazy. And like Warren Buffett says, if you buy a great company at a lousy price, that investment could be a bad investment for you, because it will take a long time for the value to catch up to the price you paid. And so that's another mistake I see traders do. They keep buying a stock on the way down to try to average down, but they don't make an exercise and a judgment as to what the right valuation for this company is. And so it's hard to value Tesla because, it hardly has any profit on the operation of the electric vehicles, even though it has great technology and it's a leader in innovation and all that. But, I sold it primarily because of the Bitcoin thing, that they said that they invested, $1.5 billion in Bitcoin. And I said, this is too risky for me. I'm going to bail. And sure enough, Elon Musk came out the other day saying that Bitcoin is actually not as good for the environment as he thought it was in the beginning. So so it's mercurial. Tesla. I don't know where it's going to end, but certainly it's a great company. The price is a little bit off the wall, but lack of diversification is another mistake that I see people doing. They focus too much on one particular stock, and I tell my viewers, oh, this you have to spend a lot of time researching companies to be able to pick stocks. If you just buy you're done. You don't need any more research, and you can actually sell puts on the index as well. So it's a great strategy, and I salute you highlighting that for all of us, because what you're doing is commendable, and you're showing people how to do it and how to make money in a disciplined way. So what's the best strategy in your opinion that traders should study in the future?
I think primarily just selling options and selling out of the money options. I know that I know that you sometimes like to sell long dated in the money options, and I do that as well. The only caveat to that is I like to sell long dated in the money options if I believe that a stock is oversold, because by doing that you're able to participate in the upside potential. So just this past week we sold an in the money option on Uber, because previous Uber fell below $45 to about $43. So I was short an existing 45 put on Uber, and I rolled that up to $50. And the reason was that I felt that Uber would increase in value, and as it increased in value, I would be able to capture the intrinsic premium by rolling up the option to be in the money. But in general, I do prefer to sell out of the money, but I will sell in the money, like you sometimes suggest, as long as a stock is, I believe, is undervalued.
Certainly. No, that's a great point you bring, because when you sell options, put options, you make money, you make your premium, but if the stock goes through the moon, you don't participate on that rise. And then if you sell it a little bit in the money or at the money, then you can participate more than by selling out of the money. You have a more secure position out of the money, but then the profit potential is of course less. So that's a great point. Certainly, what pitfalls should traders and mistakes should traders avoid in the future, in your opinion?
I think the biggest thing is really just to harken back to what I said previously, make sure that they don't trade too large. And also, I think it's important to trade high quality liquid underlyings, because if you trade an underlying that is not really that large, or that doesn't have that many, doesn't have deep markets, then it might be difficult if to actually roll that position or manage that position if it were to get in trouble. So I tend to like options on some of the largest companies, the market leading companies like Amazon or Facebook or Microsoft or Visa or MasterCard. But I think the biggest thing is making sure that you don't trade too large, because virtually almost all positions that we trade will be profitable with enough time, as long as you don't trade too large, because you can roll and manage and massage that position by like potentially selling some call options, etc. But if you run out of buying power, then you're stuck. You're going to have to close that position for a loss. So really controlling your greed and not trying to ramp up your account too large is probably the biggest pitfall and the biggest mistake that I see traders make.
That's a great point you bring, and I think if you're making 2% per month, I mean that's outstanding. I mean I tried to do 1%, maybe 1.5, and but 2% is wonderful, and also on high liquid names. You make a great point, because I mean earlier this year in the first quarter I tried to sell puts on GameStop, and I had a terrible time trying to get executed, and the bid ask spreads were just incredible. I tried to put on uh, a bear spread, and the and the money I got on the premium in the quote was less than the premium I had to pay, and the strike price, was like 10 points in between. So it was incredible.
Yeah,
but
plus the
yeah.
problem with GameStop at that time, I'm sure the buying power requirements for that was probably, 70%. So when you would sell an option, it would reduce your buying power significantly more than the typical Regulation T or portfolio margin requirements were, because the brokerages were requiring close to 100% margin requirements on those stocks.
It was unreal. I tell you, the premium was like 40% of the price of the stock, when normally, it's like 2 or 3%. So it was an unusual situation for sure. Well, anyway, do you have any parting thoughts? It's almost time. Any parting thoughts?
I think that for your viewers, definitely, I watched a lot of your videos, and I think that you're giving great advice. The only when I do definitely like selling long dated in the money put options. I guess the only caveat to that would be to make sure to take into consideration the potential volatility expansion that could happen, and also the buying power requirements. Because when you hold a long dated option, remember that you're kind of locked in to having that position reduce your buying power by a significant amount. Additionally, if you run into a situation where the market sells off by about 15%, it's a little bit more difficult to roll and manage a long dated option than it is something that's shorter dated. So if you have something that expires, let's say in 120 days, and then you have a large volatility expansion event where the VIX expands from like 15 to 30, it's harder to manage that position, because if it expires in 120 days, then in general, in order to get a more advantageous strike price, you might have to roll out that position by an additional 6 months, which means that you're going to tie up your buying power even longer. But from watching a lot of your content, and I watched a lot of your videos over the past week, and those two suggestions as far as buying power, and also being cognizant of rolling out your positions, and with a long dated option you might have to roll it out even further out. I think you give amazing advice. Your channel is incredible, and I see that you're putting out a lot of videos as well, and I think that the sky's the limit for you. I'm going to continue watching your channel and your videos, and I just love how you're incredibly honest, how you're teaching your students how to sell option premium. You're giving your thoughts. I like that Bitcoin video as well, because you made a great point where it's kind of like Bitcoin is synonymous with kind of like buying cash and then putting it in your mattress, because you're kind of just like hoping that it continues to go up. And a lot of people have made a lot of money on Bitcoin, but I liked that you expressed that take, because it shows that you're gonna share your thoughts, even if it's an unpopular opinion at that moment. And I think that that's amazing, because we need more people like you who are very honest.
Well, thank you for the endorsement, and I do wish you well. I'll continue to watch your channel and promote it as best I can. So, wish you well, David. Take care.
Thank you so much. I'll talk to you soon.
Yeah.
All right. Bye.